Uh, Welcome to the Dirty Economics discussion. We bring you a very interesting topic today. It's called inflation. Now, inflation is one of the most important concepts in economics, and the current global scenario is quite baffling. The markets are seeing high levels of volatility as the central banks around the globe try to fight their way in to boost inflation. Now, is inflation really good? Rising prices are always frowned upon by the consumers. Then why is it that the central banks are trying to push inflation higher? Strange question, isn't it? Now let's go back and revisit the textbooks to understand inflation with Mr. Omkar Godbole, who's a macro and a currency analyst. Hi Omkar, how
Hello.
are you?
Hi, Kaushal. How are you?
I'm fine. How are you?
Yeah, I'm doing good.
Okay, so Omkar, what's your take on inflation?
Uh, as you just said, the current scenario is quite confusing because no one in the world likes rising prices.
Yes.
Yes, and we constantly hear this noise from major central banks like Federal Reserve or European Central Bank or most notably Bank of Japan. They want to push up inflation.
Yes.
They are in favor of rising prices. So why is that? I mean, for that we need to look at the textbook definition of inflation.
Okay.
So every concept has a different school of thoughts. Okay, so in a similar way, in in economics we have two different school of thoughts, two prominent school of thoughts. One is the Keynesian view, and the other one is Austrian view.
Okay.
Okay. So now let me put it this way. Keynesian view is being taught across the globe in every business school or commerce textbooks for
All
the
right.
simple reason uh, being that Keynesian economics is inflationary in nature, and it helps governments to expand their own structure.
All right.
On the other hand, Austrian view is more, in favor of commodity backed currencies, and the structure of Austrian economics is such that if it's implemented, government size would get restricted, and that is the reason if you search on internet, you would not find a Austrian economic course like masters in Austrian economics or a PhD in Austrian economics. It's very difficult because governments across the globe have somehow made sure that Austrian economic concepts do not enter mainstream.
Okay. So
uh,
basically, are you telling that this is a government conspiracy that no
yeah,
people?
yeah, it's quite clear because governments want to keep control in their hands. Okay, be it US government or Indian government or any other government for that matter.
Okay, so looking at you, I can actually make out that you prefer Austrian economics on any point of the day.
Yeah, yeah, sure. I'll explain you why it's so interesting. Coming to inflation, as I said, there are two school of thoughts:
Yeah,
Keynesian view and Austrian view. Now, Keynesian view definition is very simple. All it says is, rise in general price level is inflation. Okay,
yes,
so the general price level across the globe is CPI, Consumer Price Index,
that's right.
and Austrian view says, it's not rise in prices, but it's rise in money supply. Okay, so amount of money that is being printed by a central bank and pushed into the economy. If
Okay,
that rises, it's inflationary. So the basic difference here is uh, Keynesian economists, uh, they concentrate on CPI, meaning now you need to understand that CPI is just an index. It's actually not an inflation.
okay,
CPI is an index that is being created by governments and central banks,
all right,
and it includes those things which, according to them, are uh, basic necessities, or according to them, these are the things which rightly represent inflation. However, inflation can occur in any sector.
all right,
And the other point is that prices never rise uniformly across the board. If you have 10 sectors in an economy, one sector will see a sharp price rise, other sectors will see moderate price rises. So the prices never rise uniformly.
Okay, so basically, Keynesian economics is actually just the tip of the iceberg, while Austrian economics fundamentals are actually go very deep and they try to actually find out what is happening and everything.
Yeah, the simple point here is that Austrian economics, uses basic demand and supply thing.
All right,
Whatever increases in supply, the value drops, right?
right,
So if you view money as a commodity and not just a medium of exchange, okay?
all
You
right.
view money as a commodity, and now if your supply of money increases, what would happen? Its value would drop down, right?
That is right.
Which is nothing but whatever you measure in terms of money, its value rises.
That's right.
And that is why when money supply rises, the value of money drops. Or in currency markets, we see, if money supply figures rise, the currency depreciates. And
Okay,
because the currency depreciates, whatever is measured in terms of that currency, it starts looking costly.
okay.
And that is the Austrian view, and that is why I prefer Austrian view, because you see what happened after 2008. Federal Reserve did QE,
That's
the
right.
ECB has been doing QE, and most of the people thought now the CPI index will go to 3%, 4%, or 5%. It never did. It hardly went up to 2% at some point, and since then it has been falling or at near zero levels.
That's right.
But and so what Keynesian economists now tell is that QE has not resulted in inflation. Let's do more QE. Let's do more rate cuts. And
Okay.
that's where they are kind of wrong, because inflation has occurred. We have witnessed hyperinflation, but we have witnessed hyperinflation not in real economy but in financial markets.
All right.
DAX rising to record highs or Dow Jones rising to record highs. It's not due to fundamentals. It's just the hyperinflation. The reason being, money supply, the money supply that increased following QE and interest rate cuts,
Yeah,
it did not enter into real economy. It entered into stock markets.
that is right. We saw a lot of corporates actually buying back their stocks, leveraging from the Q, and it was
Yeah.
just related bubble.
And that is why the inflation, which was supposed to occur in the main economy, it occurred into financial assets.
That's right.
Or the other way of looking at this is, you increase supply of money, so whatever is being measured in terms of money started looking costly. So even shares you measure in terms of money, right?
Right.
Value of shares. So you increase supply of money, the value of money falls, which indirectly means the value of shares would start looking costly, or shares would rise. And that is why we have had hyperinflated stock markets. People like to call it as a rally, bull rally, but it is not actually a rally backed by fundamentals. It's simply because money supply increase and value of money drop, and so whatever is being measured in terms of monies has become costly suddenly.
That's right.
And that is, whatever is being measured in terms of money has started looking costly. And that is why stock markets rallied. So this is the basic difference. Keynesians just restrict themselves to CPI, and they do not take into consideration that it's actually rise in money supply that is inflationary, and not rise in price levels that is inflationary.
Okay.
And when you look at Keynesian, then there comes a discussion of two varieties, that is asset price inflation and economic inflation. Economic inflation is when CPI starts rising, let's say from 1% to 2% to 3%. Then you have all those Keynesian economics saying, okay, we are having inflation in economy.
Okay.
And asset price inflation is just a rally in stock markets, or you know risky assets, and that is usually termed as asset price inflation. But in Austrian view, it is pretty simple. If central bank increases money supply, the value of money falls down, and which indirectly means whatever is being measured in terms of money will start appearing costly.
Okay.
And from a trading viewpoint, I would say that applying Austrian view is far more beneficial rather than Keynesian view.
But don't you think that if you, like, as you mentioned before, that we saw QE fueled the stock market bubble. So as a trader, if I'm dealing in the financial markets, so
Yeah.
do you think I need the basic knowledge of both the school of thoughts?
Yeah, yeah, of course. See, you need basic knowledge of both school of thoughts, because if you were a trader in 2008 and if you were aware about Austrian view of inflation,
Okay.
you would have poured your money into stocks
All right.
with, okay, and you would have also understood that the rally in gold that we saw to 1900 levels was actually a trap for bulls,
All right.
because the rally was fueled by Keynesian economists. They thought QE would lead to hyperinflation, that is a sharp rise in CPI.
All right.
Okay, but that never happened because the liquidity that was created, it went into stock markets. And when your stock markets are rising, people would not prefer to hold gold for longer period of time. So by 2011, 2012, general people started realizing that we are not really having the economic inflation.
Okay.
We are having hyperinflated stock markets, and that's why then the money started switching out from gold to equities and other assets, and then we had this big fall in gold.
Yeah.
So if you were aware of both of these definitions of inflation, it would have been a very common sense trade kind of thing. Buy stocks in 2008,
Okay.
and you could have also, and now it's actually a time to buy gold, simply because these hyperinflated stocks, they were all due to liquidity. So when you boost liquidity, whatever has gone up, it will eventually come down when you start putting restrictions on excess liquidity.
That is right.
So indirectly the safe haven demand for gold would rise now.
Okay. So like coming back to inflation and coming back to the stock market. Now we both have been into the trading background for quite some time right now. So assume
Yeah.
that I'm a retail trader and I want to actually observe both the Austrian and the follow both the Austrian and the key nations uh,
Okay.
view on inflation. But how do I actually measure inflation? How do I understand what is going to move ahead? Something that related to both the concepts. See, if for example, if I want to position myself for a trade on gold tomorrow, but
Okay.
I know that gold has a strong correlation with the inflation as such.
Yeah.
So what will the first thing that I should be looking at when I get up in the morning before I start positioning?
See, if you're a gold trader, you'll have to look at, and especially if you're a short-term trader, these things would not matter much,
Okay.
uh, because there are a lot of other things, technical factors that come into play.
All
Uh, then there are, daily clues that you get from stock markets or bond markets, or what a central banker has said. They want to tighten policy or they want to cut rates, etc., etc. But on a long-term basis, if you take any central bank's money supply chart, you would come to know that money supply has never contracted actually.
yeah.
Money supply keeps on increasing on a long term basis. And so it's quite simple that you view money as a commodity,
Okay.
and if its supply is on a long term rising trend, it means its value is also on a long term losing trend.
All right.
And thus it's always beneficial to hold gold, because gold is a hard currency, and you cannot print it at your will,
All right.
and you can always prefer to hold some amount of your, allocate some amount of your investment to gold that way.
Okay.
And you should not really look at what's happening in CPI, because it's misleading, because CPI, I've always believed, and I've said it time and again, that CPI is just an index, that has been formulated by governments and central banks. It doesn't necessarily tell you the real picture of inflation in an economy.
Oh, okay.
A-
Okay.
a-
Okay.
and especially in advanced economies like United States or Japan, I'm not calling them advanced because of their GDP, etc. They, they are in doldrums now. Everybody knows that. So
That is
going by that, they are not advanced economies. What I mean to say by advanced economies is they are low population economies.
okay.
So CPI is not actually a preferred inflation gauge over there. CPI is a preferred inflation gauge in India, China, countries with high population and where sensitivity to food prices is very high.
Okay.
So in India, if a central banker, our central banker looks at CPI and keeps a target for CPI, it is understandable, you know. But in United States or in Canada or countries like Japan or European nations, CPI is not that important. For them, more important is the asset price inflation, because when asset prices rise, like let's say if stock markets rise, they don't necessarily add to economic growth. But when there is asset price deflation,
All right.
it will surely affect the growth. Because let's say I'm a common man. I look at Sensex and I see Sensex. It has jumped from, let's say, 25,000 to 30,000 or 35,000. As a common man, I feel happy about it. But
Okay.
just because Sensex has gone from 25K to 35K, I will not start taking loans or consuming more or spend more money on big ticket purchases.
That is right. That this is something that we need, all the retail traders should be actually listening to and taking into consideration, because the stock market, a booming stock market or a bullish stock market, is not an indication of that indication of a indication of growth actually. So it doesn't.
Yeah,
So we friends speak a lot, and we always get happy that Nifty
yeah,
rose 1,000 to it
yeah,
made a top at 9,000. We are
yeah,
so happy, like India is doing so great. I mean,
yeah,
India is not doing so great. The stock markets has it
yeah,
was just fuel everywhere.
yeah. And the irony is that, the same people, if they see stock markets falling,
Okay.
they'll postpone their consumption. They'll say, "Oh my God, something has gone wrong. So I was planning to buy a car or I was planning to buy a house.
Right.
Let me put brakes on it, my plans.
Okay.
I'll postpone it." But when stock market rallies, they won't prepone their consumption. They'll just feel happy about it. Yeah, okay, stock markets are rising, everything is good. But they won't consume or they won't boost their consumption. And that is why when asset price inflation happens, it does not add to economic growth. But when there is a deflation, asset price deflation, or what is popularly known as economic crash, financial market crash,
Yeah.
it surely pulls down growth. So I believe for advanced economies, the more concern is the hyperinflated asset prices rather than CPI, etc.
All right. That's good. So, what lies ahead with regards to inflation, especially with central banks trying to achieve their they have their inflation mandates, and people are trying to achieve 2% of inflation.
See, my take on it is very blunt. I feel all this talk about 2% inflation target is all sorry to say this, but it's all crap. I feel the real reason to keep rates low or do QE is simply to write off their debts.
Okay.
They are all suffering from debt crisis, and the best way is to keep rates low, and so that writing of debt becomes very easy. And uh, I always believe that Federal Reserve policymakers or European central bank policymakers, or for that matter, Bank of Japan policymakers, they know that they are not going to achieve 2% inflation target, but they are just selling it that way to markets or common persons, that they are working hard to push up inflation so that it will bring growth. Because you think about this way, Japan has a debt to GDP ratio of 260%.
So that is the rising.
Yeah, and what is the bond yield, 10-year bond yield? It is into negative. So it's almost like an indebted nation, and indebted nations bonds, if I purchase bonds, I have to pay them yield rather than get yield on it.
Okay.
So
Yeah.
it wouldn't.
This morning I heard an interview of Jim Mellon, who's a very famous trader. He actually gave a bold quote. He told that sell everything which has a negative yield,
Right.
go buy gold, go buy silver.
Absolutely. Because this
Yeah.
this
He
this
also
ideally should not happen, right?
that
You have an indebted nation and their bond yield is trading into negative. It should actually trade at 20% or 30%. They are in debt crisis.
that's right. Okay, so I like the discussion today. We spoke on inflation. So Omkar, maybe we can do something which relates gold and inflation for our
Yeah,
commodity.
I guess we can come out with a nice historical chart about money supply and gold, and then we can give outlook of maybe what's going to happen over next year or next couple of years.
Sounds perfect. So when I get up in the morning tomorrow, do you think
Yeah.
I should be looking at the chart of gold and maybe put in some trades over there on the bullish side?
Yeah, I guess actually I would prefer to sit on sidelines tomorrow because we have that non-farm payrolls and wage growth numbers in the US.
All right.
So it's a lot of scenarios. I see non-farm payrolls is not an important number anymore. It's about wage price inflation, as they say.
That is right.
So if wage price inflation now, see, again, I would like to conclude the talks by giving you an example that we are living in such twisted times. You know, uh, Actually, rise in inflation is usually a bad news for currency.
Okay.
If you look into history, rise in inflation would actually lead to depreciation in currency. Or let's take an example of India itself. In
Yeah,
India, if you have a higher CPI number, USD INR rises, which means INR depreciates, right?
that's right. That's right.
Yeah, that is a textbook case, and it indirectly tells us that India is far more strong, or let's say running a textbook economy than all the other nations. But
Can
you have a look at UK or US. It's twisted over there. If the inflation rises, their currency becomes strong. I don't get it. Just because you know uh, it's a sort of markets pricing a rate hike in advance, because markets feel that if rate hike inflation is rising, that is good for economy, and then Federal Reserve or European Central Bank, or these people would hike rates, and just because of that, when you have higher inflation numbers, their currencies strengthen. I mean, I don't understand it actually.
okay. Okay. So we have the non-farms tomorrow. If we see a rise in wages, do you think we'll have we'll have a blip higher in the inflation expectations in US and maybe some pricing in, oh no, some increase in pricing in for the June rate hike maybe.
Yes, and so you will have a strong dollar and weak gold,
Okay.
unfortunately.
So maybe I should stay on the sidelines tomorrow for the gold.
Yeah, of course.
Okay, my God, sounds perfect.
Yeah.
It was nice to have a chat today.
Yeah, it was great to chat on, my favorite topic, inflation.
I hated inflation. Nice chat, Omkar. Thank you so much for listening, guys. We'll meet you next week. We'll try to cover inflation and gold, and maybe do a short bit on Nifty on Tuesday, maybe.
Yeah, perfect.
Perfect. Anyway, okay. Tata, Omkar. See you.
Bye
See you
bye.
tomorrow. Bye
Yeah.
bye.